Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Thursday, the 31st of July. I'm Caroline Hepke in London.
And I'm Stephen Carroll. Coming up today, keeping things magnificent. Meta and Microsoft deliver bumper results as big tech powers stock market gains.
The Fed keeps interest rates steady, but Powell's committee sees dissent from not one, but two Fed governors for the first time since 1993.
Plus, an exclusive report on why developers say safety regulations imposed after the Grenfell Tower tragedy in the UK have made it too complicated to build new high-rises in the country.
Let's start with a roundup of our top stories.
Meta is taking advantage of its lucrative advertising business to spend more aggressively on artificial intelligence after it reported second quarter earnings that beat Wall Street estimates. The Silicon Valley giant forecast third quarter sales that could go higher than $50 billion and raised its 2025 capital spending forecast up to $72 billion. Here's more from Bloomberg technology anchor Caroline Hyde.
The generative AI is making their advertising more easy to use. Marketeers want to lean into it. No wonder you're seeing the pricing of those ads going up by about 9%. They're able to charge more broadly. And they're also trying to articulate, what does superintelligence labs mean for them? Yes, they've been spending in CapEx, but boy, have they been spending big on talent. We've heard about the $200 million pay packages, the amount they spent on Scale AI. But all of this is about making it more personable.
Bloomberg's Caroline Hyde there as Meta executives, including Mark Zuckerberg, said its AI technology is already producing, quote, meaningful revenue.
Microsoft is expected to reach a $4 trillion market cap after it reported quarterly earnings that beat Wall Street estimates. The big tech stalwart would be only the second company to hit that milestone after the chipmaker Nvidia at the beginning of July. The jump in shares was fueled by a 39% increase in revenue from Microsoft's Azure cloud computing unit. Dan Ives, global head of tech research at Wedbush Securities, shared investors' optimism.
Massive beat on cloud. You see more and more of these use cases, these hyperscalers, those are the best indicators. That just shows where the next spending in AI is going. And that's why right now, if you're a tech bear, you're in hibernation mode in that cave and you can't find AI in the spreadsheet.
Dan Ives speaking there, the global head of tech research at Wedbush Securities, after the Microsoft CFO Amy Hood told analysts that she expects to see full-year revenue growth in the double digits.
Standard Chartered reported expectation-beating second quarter earnings. Adjusted pre-tax profit came in at $2.4 billion, beating estimates of $1.9 billion. The lender also announced a fresh $1.3 billion share buyback as part of a plan to return at least $8 billion to shareholders between 2024 and 2026. Shares in Standard Chartered up slightly after the break in Hong Kong.
Societe Generale raised its profit guidance and announced a €1 billion buyback in a show of strength for the bank's turnaround. SocGen says that it expects return on tangible equity to be 9% this year. That's above the 8% it had previously forecast. The French lender has been cutting costs and getting rid of poor assets in a bid to change its fortunes. Its shares have had a stellar start to the year, rising 92% as investors see a return to profit.
The Fed Chair Jerome Powell says interest rates are in the right place as the central bank opted to hold borrowing costs steady for a fifth straight meeting. However, for the first time in over 30 years, two Federal Reserve governors broke from the majority to call for a rate cut. Michelle Bowman and Christopher Waller dissented in favour of a cut, highlighting growing divisions within the board. Speaking to reporters after the decision, Chair Powell addressed the vote split.
What you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making. And we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there.
The 9-2 FOMC vote split comes as intrigue grows over who will replace Powell once his term ends, as President Trump continues to pressure him to cut rates. Meanwhile, traders have paired bets for immediate rate cuts. Markets are now pricing in around a 50-50 chance of a reduction at the next meeting in September.
Well, US President Donald Trump has reached a trade deal with South Korea while issuing a barrage of new tariff announcements. The US will impose a 15% one-sided levy on imports from South Korea, one of the world's largest exporters. President Trump also said that he would start applying taxes to small packages from all countries coming into the US and would up tariffs on India to 25%.
They don't do very much business in terms of business with us. They sell a lot to us, but we don't buy from them. You know why? Because the tariff is so high. They have one of the highest tariffs in the world. Now, they're willing to cut it very substantially, but we'll see what happens. We're talking to India now. We'll see what happens. It doesn't matter too much whether we have a deal or whether we charge them a certain tariff, but you'll know at the end of this week.
Now, that was US President Donald Trump. Many of the US leaders' negotiations are going down to the wire. His self-imposed deadline for trade deals comes tomorrow. Malaysia, Thailand and Cambodia are expected to formally announce deals ahead of that. The US also delayed the implementation of a 50% tariff on Brazil's exports and exempted a large number of goods, though, from that levy.
The global copper market is reeling from President Trump's 50% tariff on imports of the metal as the president exempted key products, including refined metal, from the levy. The unexpected move triggered a record plunge for US prices, hurting traders who tried to anticipate the changes by hurrying the metal into the US. Copper futures on COMEX in New York plunged by more than 20%, the most ever, as traders reacted to a move that recalibrates the value of metal in the US versus the rest of the world. According to a White House statement, the semi-finished products such as pipes and copper-intensive goods like cables will now be subject to the new tariffs.
Those are our top stories for you this morning. Let's look at the markets. So stock futures then for the US are absolutely surging on the back of bumper earnings. Microsoft shares gained 8% after hours. Meta up more than 11%. NASDAQ stock futures at the moment higher by 1.4%. European stock futures also up by 0.25%. South Korean stocks down this morning alongside Indian shares because of those tariff announcements. Copper price differentials between the Europe and the US have really collapsed. China's factory activity worsening in July. You've also got CSI 300 stocks down by 1% on the back of that. And then after the Fed's decision to hold interest rates steady, 2-year Treasury notes were 7 basis points higher yesterday, although little changed this morning. So that's a look at where we are in the markets.
In a moment, we'll bring you more on the market reaction to those Megacap tech earnings and the latest trade headlines, plus why high-rise building projects are facing increasing delays in the UK. But in the story that we've been reading this morning, this is about artificial intelligence and its use in financial markets. And a study by researchers at the Wharton School of Finance have been looking at a fundamental flaw, is that essentially even when humans aren't involved, AI bots are ganging up together.
Well, this is the initial conclusion of this research. It's a trio of researchers at Wharton, including finance professor Ite Goldstein. So they carried out a simulation of real-world markets and trading. Obviously, that's difficult, but they did this with artificial intelligence bots or traders. Now, the conclusions of this are that instead of battling it out for returns, the AI traders actually ended up fixing prices, they hoarded profits, and they sidelined human traders, i.e. the kind of worst nightmare for regulators. And this has got a lot of attention from asset managers, from regulators. Even though the research doesn't say that AI collusion is happening in the real world, even though a lot of traders are already using AI. But yeah, it's a really kind of fascinating view.
My favourite part of this is that essentially the AI figured out that once they've done a good enough job, they could just give up and stop looking for new strategies, which sounds, to be fair, very familiar. So I think that this is, you know, the fact that I almost respect the AI for basically saying, I've done enough, actually.
Yeah,
that's
I've
fine.
made enough money, that's good enough for me. Well, my addition to this is that I really want to shout out to Wharton for their YouTube channel, because I got to actually listen, and we wrote a long piece about it, which is very interesting. But we also got to hear from the professor himself on the Wharton's YouTube channel. So yes, a shout out to them, I think.
We'll put a link to our story by Lu Wang in our podcast show notes. But let's turn to the markets now and investors navigating a barrage of headlines, central bank decisions, tariff agreements and those big corporate earnings as well. We've got our Markets Live strategist Mark Cranfield with us for more on all of this. Mark, good to talk to you. Let's start then with those results. Shares in Meta and Microsoft surging after hours on Wall Street, and that's really rippling across markets elsewhere too.
It's kind of reassuring for global investors. They're a little bit uncertain about which way tariffs are going to go, how quickly before they make a serious impact on global growth. There's been all kinds of warnings, and yet these huge companies continue to make tremendous profits. We saw it also from Alphabet last week as well, and they post very positive outlooks as well. So there's a kind of reassuring factor to equity investors around the world that companies can continue to do extremely well even under these uncertain conditions. And they still think that the AI story is so big and so profitable that it can override whatever uncertainty you see in terms of central bank policy, government policy, wherever you see there's a lack of clarity in different parts of the investing landscape. Don't need to worry because AI will overwhelm all of that. That was a particular part of the Meta story. They see it's time to even increase their investment into AI because the opportunity there is so big. So that's something that investors can look at and they can decide, yes, that's somewhere where we can put our money because it's tangible and we can see the results reasonably quickly in that, even though we're not sure about some of the other parts of the global world.
Yeah, maybe justifying the record highs in terms of US stocks that we've seen recently, I suppose, would be the argument. But you mentioned the uncertainty about policy. So the Fed held interest rates steady. Powell shrugged off all the pressure from the White House. But we mentioned that 2 Fed governors dissented, and that is highly unusual. So where next for the Fed?
Yeah, governors dissenting it's been a couple of decades since that, but it's not unusual to have dissenters in general. We've had Fed voters on the day going against the Fed decision, some of the regional people. So it's a bit of a nuance, really. Investors won't be too excited the fact it happens to be governors, and obviously they would also be looking at a bit of a political aspect to it as well, considering that there's been so much talk about who might take over from Jerome Powell, and that at least one of the candidates could be somebody who's currently on the Fed board at the moment. So there's a pinch of salt with all of that. What it does do is it pushes back pretty hard against the idea that September was, at one stage, we were thinking it was almost a shoo-in for an interest rate cut in September. That's certainly not the case now. It's becoming a bit more of a coin toss. And even by the time we get there, if Jerome Powell hasn't really changed his narrative at all, we might even be thinking that it's going to be another hold in September as well. Quite a way before we get to that decision. But certainly his press conference in particular, he wasn't like a man who sounded those. There's certainly no need to panic. He doesn't sound as though he's in any rush, wants a lot more time to assess the data. And if he looks at the stock market, for example, as an indicator of what people think about the US economy, then there's certainly no rush to lower interest rates on that basis.
And perhaps that's also factoring into the thinking around trade as well. We've had another raft of tariff announcements, 15% for South Korea, 25% for India, 50% for Brazil, with some exemptions though as well. I mean, how are markets taking this latest deluge of trade headlines?
Generally in their stride, really. I think it's partly because there's just a lack of details. Every single deal that's been wheeled out this week really has been very scarce on hard details. There's a lot of exemptions as well for people to get their head around. There's nothing apart from some of the headline numbers. There's not too much that investors can say that really applies to this transaction or that transaction. So a lot of head scratching on what it really means. And when they look at the US markets, the way that equities are performing so strongly there, they'll think, well, if American companies can continue to perform as strongly as that, then that's a pretty good indicator for what we can expect in the rest of the world. So definitely not the scaremongering that we had at the beginning of the year when people were very concerned where we were going with this. Doesn't mean to say it's a non-event, but the bar is much higher for making people worried that tariffs are really going to bring the world to a grinding halt. It doesn't look like that way. Considering the way that people are investing their money, it doesn't look as though people are really scared about the outlook for the global economy.
Okay, Mark Cranfield, our Markets Live strategist, thank you very much for joining us. And as we're thinking about today's European trading session as well, just to mention the other banking results we've had out from Europe, a set of beats from BBVA, significantly higher, 400 million is the beat on their profit number for the second quarter, coming in at 2.75 billion. ING also higher than expected. And in France, Crédit Agricole also beating by around 400 million euros as well. Their net income, 2.39 billion as well. So some positive reports out of those big European banks too.
Now, to Britain's housing crisis. Developers in the UK say that safety regulations imposed after the Grenfell Tower tragedy in London have made it too complicated to build new high-rise buildings. Joining us now is Bloomberg's global business reporter Jennifer Creary on this story. Jennifer, good morning. So what exactly is the problem and how did it come about according to the developers?
After the Grenfell Tower fire in 2017, so that's the tragedy where 72 people died in a tower block blaze in London, the government brought in a bunch of reforms to high-rise construction because basically one of the key issues was low adherence and enforcement to existing safety regulations. On top of that, there wasn't really a single authority overseeing the issue. Now, these reforms, which came into effect in October 2023, were meant to ensure that developers pass certain checkpoints before construction even begins. You know, for example, giving detailed plans for fire alarm placements, exits, etc. The problem is under this new regime is just so much red tape and so much confusion over what's required from applicants that they're simply taking too long. So there's essentially a backlog now. One of the private equity firms we spoke to bought a plot of land in Battersea in 2021 for £31 million. To this day, they're still waiting for permission to build. And, you know, when we spoke to the regulator, they told us that the average wait time for approval to begin building these new builds is 21 weeks. But we've interviewed companies that are waiting up to a year for approval, and that's simply too long for them.
How dire is the situation at the moment for these developers who are trying to build?
Yeah, I mean, for them, the longer they wait, you know, the higher the risk there is of lower returns. So either they'll have to shoulder, you know, higher financing costs via higher interest rates. There's inflation, demand could fall. So you can see the incentive to build very quickly. We spoke to one of the UK's largest house builders who said that their firm is waiting for roughly 500 of their homes to be signed off. Now, that's going to make it harder for builders to secure construction loans from banks because lenders now have to include years' worth of deferred interest payments to their calculations. So the situation's getting pretty dire for them.
Yeah, and the backdrop to this is that the government wants to build many more homes, wants to see many more homes being built, and London development's actually fallen off a cliff in the latest kind of details, latest numbers, 2023 to 2024. How are the developers trying to address all of this and trying to adapt to the new system? I mean, what are they thinking about?
Yeah, so parts of the industry are trying to find loopholes around the new safety regime. So, for example, building new builds that are under 18 stories so they don't have to apply for this kind of approval. We've also spoken to some firms that are shifting away from residential buildings, looking at kind of co-working spaces, things like that. Some of them are also shifting investments to the Middle East. We've heard of some companies laying off construction teams because money's so tight. So the industry is trying to find a way around this. I think the broader picture here is, the government needs them to build homes as well. The government has this ambitious target to build 1.5 million new homes by 2029. So that's 300,000 homes on average per year. That's a very ambitious target. And if these delays continue at the same rate, that target's getting further and further out of reach.
What about the kind of reaction to this? Has the government or regulator done anything to actually address the issues?
Yeah, so the regulator acknowledges that there's a problem. There's no doubt about that. They said that they're trying to boost staff. We submitted an FOI request that showed that there are only about 70 staff leafing through more than 1,000 applications in 1 month. So, there's a serious crunch in that aspect. But the regulator has also pushed back. They argue that a lot of these applications are poor quality, so applicants who, didn't read the fine print or they're not submitting the right application, the right documents. Their argument is, how can they build safe homes when they can't fill in an application like this? Another point that the regulator made was that 30,000 out of the 1.5 million homes the government wants to build are currently going through this process, and that's only a very small proportion of the overall target, about 2%. I think if we step back, the people that we've spoken to in the industry, they are broadly in support of these safety reforms. No one wants a repeat of the Grenfell tragedy, but the issue is how do they bring about these reforms in a system that's already under strain and struggling to meet demand.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.